Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
Great to be here.
Usually when we do a deep dive into the global economy, we spend a lot of time looking right here at home in the U.S.
Right, naturally.
Yeah, we're always tracking what President Trump is doing with tariffs or, what the Fed is up to this week.
Always a lot to talk about there.
Exactly. But today, I actually want to pivot. I want to look across the Pacific at Japan because if you look at the data coming out of Tokyo right now, and we're in February 2026 here, the country just feels completely different than it did maybe 5 or 6 years ago.
It really does. It is not the Japan of the lost decades anymore. That narrative is dead.
Totally dead. And historically, when Americans think of Japan, you think of incredible tourism, great food, anime, maybe the aging population.
Sure.
But recent analysis paints this picture of a country that is essentially under construction. Like there are cranes everywhere. They're actually calling it an industrial renaissance.
That is the perfect term for it, honestly. And it's being driven by pure necessity. Japan is aggressively rebuilding its domestic manufacturing. They are completely overhauling their energy grid to go green.
And the AI stuff, right?
Yes, the big one. They are building massive AI data centers just to keep up with the global tech race.
Right, and that is exactly the hook for today's deep dive. Because, we can sit here and talk about cool robots and new factories all day, but we're investment analysts.
Right, we have to follow the money.
We have to ask the boring, practical question, who is paying for all of this?
And that is the multi-billion-dollar question right now.
Because building an AI data center isn't like, buying a new company laptop. We're talking about billions of dollars in upfront costs.
Absolutely.
And usually you just assume a Japanese company would walk down the street to a mega bank, get a loan, or maybe sell some stock on the Tokyo Exchange.
You would definitely assume that. But the financial plumbing in Japan has completely changed.
Changed how?
Well, the traditional piggy banks, those regular banks, and the public stock market, they're really struggling to fund this specific type of growth. And that gap, that friction, has opened the door for a massive influx of what we call private capital.
Okay, so today we're going to explore why Japan's industrial renaissance is really a story about the rise of private credit and why huge U.S. firms are suddenly rushing to lend money in Tokyo.
It's a fascinating shift.
But before we get to the solution, let's unpack the problem. Why is money suddenly so hard to get from the usual sources?
To understand that, you really have to look at the cost of money itself. For years, Japan was famous for having basically zero interest rates.
Right, money was free.
Essentially free, yeah. If you were a corporate CEO, borrowing was completely painless.
That was the whole Abenomics era, right? Endless stimulus.
Exactly. But looking at the data, that era is officially over. The Bank of Japan, the BOJ, has fundamentally shifted its strategy. As of December 2025, they actually raised policy rates to 0.75%.
Now, I want to pause there because for you listening here in the U.S., 0.75% might sound tiny. We're used to rates bouncing around, 4 or 5%.
Oh, sure. It sounds like nothing to an American ear.
Right. But in Japan, going from 0 to 0.75%, that's a seismic shock, isn't it?
It is a massive structural change. What it means is there is finally a real cost of capital. Money has a price tag now.
Yeah.
And when money costs money, companies have to be way more disciplined about how they use it. You can't just borrow just to borrow anymore.
Okay. So the environment's tougher. Let's look at what they're actually trying to buy with this more expensive money. You mentioned AI data centers, green energy. In finance terms, this is all CAPEX, right? Capital expenditures.
Correct. And this is a really crucial concept to grasp. CAPEX is very distinct from just regular operating expenses.
Let's break that down for everyone. We love a good, simple analogy here.
Sure. So think of it like owning a car, putting gas in the tank, getting an oil change, maybe paying for your insurance. Those are operating expenses.
Like the day stuff.
Yeah, you pay them this week to keep the car running this week. It's strictly short term. CAPEX, on the other hand, is like deciding to build a massive commercial garage from scratch so you can start a mechanic business.
Okay, so I see where you're going.
You have to pay for the concrete, the wood, the tools, the labor, all of it up front. It costs an absolute fortune. And you won't see a single dime of profit from that garage for maybe 5, 10, or even 20 years.
That's a huge commitment. So you're essentially pouring cash into the ground today, crossing your fingers that it pays off in 2040.
Precisely. And that is exactly what Japan is doing right now. They aren't just buying gas for the car, they are upgrading the entire national infrastructure. And these projects, especially those AI data centers, they have a very, very long payback period.
And this is where the traditional Japanese banks start to get cold feet. Because I know if I went to my local bank and asked for a huge loan that I couldn't pay back for 20 years, they'd probably laugh me out of the building.
They absolutely would. And in banking terms, looking at the research, this is called a maturity mismatch.
Maturity mismatch. Sounds very technical, but it's pretty logical when you think about it.
It's very
Okay, so the banks are basically saying, look, we love the idea of an industrial renaissance, but we cannot fund a 20-year project with people's checking account money.
exactly.
So that leaves the stock market. Why don't these big Japanese companies just issue and sell more shares? Isn't that essentially free money? Don't have to pay it back like a loan?
It's not free at all. In fact, right now in Tokyo, it's incredibly expensive in a different way. It comes down to a concept called dilution and this huge new pressure for capital efficiency.
Ah, right. Capital efficiency is like the biggest buzzword in Tokyo right now. The stock exchange reforms are pushing these companies to stop hoarding cash and actually treat their shareholders better.
Yes. So let's use a pizza analogy. Imagine a company's total profits are a delicious pizza. If you own a share of stock, you essentially own a slice of that pizza.
Okay, I'm with you. I like pizza.
Right. So if the company decides to sell more stock to raise money for a new factory, they're basically cutting that same pizza into thinner and thinner slices to feed more people.
So my personal slice, my share of the profits gets smaller.
Exactly. That is dilution. And right now, according to the data, Japanese shareholders are becoming very activistic. They are demanding that companies increase the size of their slices, not shrink them.
So if a CEO goes out and announces a massive stock sale that dilutes the current owners,
The stock price completely tanks, the shareholders revolt. It's basically corporate suicide right now.
wow. So they are genuinely stuck between a rock and a hard place. The banks are saying, sorry, too risky, and the shareholders are screaming, don't you dare dilute our shares. But they still have to build these data centers.
Which brings us to the third option. This is where private credit steps in.
Let's define this clearly for the listeners. When we talk about private credit or private capital, we are not talking about banks. We're talking about massive private investment firms, places like Apollo, Carlyle, Blackstone.
Correct. These are global investment firms that manage huge pools of capital, usually from pension funds, insurance companies, or sovereign wealth funds.
Now, I have to play devil's advocate for a second.
Yeah.
In the U.S., when we hear private credit, we sometimes think of it as, shadow banking or high-risk junk loans to distressed companies that just can't get a normal bank loan.
Right. That's the stereotype.
Is that what's happening in Japan? Are these just zombie companies trying to stay afloat?
No, and that is a really common misconception. But the recent analysis from Japan tells a completely different story. This is not about rescuing failing companies. This is about funding investment-grade safety and growth.
So these are perfectly healthy companies.
Extremely healthy. They just need a very specific type of money that regular banks simply cannot offer. We call it bespoke capital.
Bespoke, like a custom-made suit.
Exactly like that. Think about the difference between buying a suit off the rack at a department store versus going to a master tailor. A traditional bank loan is off the rack. It has the standard terms, a standard duration, standard monthly payments. You either fit into it or you don't.
And if your project is a weird shape, like a super complex AI data center that won't make money for 5 years, the off-the-rack suit just rips.
Right. Private credit firms are the tailors. They can sit down with a Japanese CEO and say, okay, you need 20-year capital. You won't have any cash flow for the first 3 years while you build, but then you'll have a ton. So let's structure the loan so you don't pay us anything for 3 years, and then you pay us more later.
Wow, so they completely customized the repayment schedule to match the actual life cycle of the project.
Exactly. They can lend against highly specific assets. They can adjust the rules of the loan, the covenants. It's a level of flexibility that banks literally cannot legally or operationally provide.
Let's look at a real-world example of this, because I think it really helps ground the theory for everyone listening. The research highlights this major deal involving Sony Music.
Yes, this is a textbook example of this exact trend. Sony Music needed capital for expansion, but they absolutely did not want to hurt their credit rating or dilute their stock. So Apollo, the huge U.S. firm, stepped in and provided a $700 million capital solution.
$700 million.
Right.
That is a massive check. But what actually made this deal bespoke? Like, why couldn't a regular Japanese bank just write that check?
Because of what the loan was secured against. It was backed by Sony's music royalties, their intellectual property.
Ah, okay, so they pledged the future earnings of their song catalog.
Exactly. Now, traditional banks really struggle with that. How does a bank algorithm value a pop song's catalog for a 20-year loan? It's incredibly hard for them to process that kind of risk.
Yeah, that's not a factory or a piece of real estate.
Right. But Apollo has these specialized teams that deeply understand media assets. They can look at the streaming data, look at the historical royalty cash flows, and say, we know exactly how much this is worth.
So Apollo creates this custom loan that perfectly matches the long-term cash flow of the music. Sony gets the $700 million without selling any stock, and Apollo gets a really steady, safe return for its investors.
Precisely. And we actually saw a follow-up to this. In January 2026, Sony Music partnered with GIC, that's Singapore's sovereign wealth fund, for another massive catalog investment. It just proves that this combination of institutional capital and operational expertise is the hot new trend.
It's fascinating because it feels like these private firms are acting almost more like partners than just lenders.
They really are.
But this brings up a geopolitical question in my mind. You have these huge American firms like Apollo and Carlyle and foreign funds like GIC coming into Tokyo and writing these massive checks. How are the local Japanese banks reacting to this? I can't imagine they're thrilled about losing out on all this business.
You would definitely think it would be this massive turf war, right?
Yeah.
Foreign barbarians at the gate stealing the best clients.
Yeah, exactly.
But the reality is actually surprisingly cooperative. It's less of a war and more of a marriage of convenience. According to the data, Japanese banks and U.S. private capital firms are actively forming strategic partnerships.
Like frenemies.
Kinda, yeah, but highly functional frenemies. You see, the Japanese banks, places like SMBC or MUFG, they have the ultimate Rolodex. They have these 100-year relationships with literally every CEO in Japan. They know the culture, the local regulations.
But as we said earlier, they don't have the long-term risk appetite.
Right. And the U.S. firms have the deep pockets and the structuring expertise for these complex 20-year loans. So they team up. The Japanese bank makes the warm introduction, maybe handles the currency, hedging, swapping yen for dollars, and the U.S. firm provides the actual long-term lending capital.
Oh, wow. So everyone actually wins here. The Japanese bank keeps its relationship with the client, the U.S. firm gets to put its billions to work, and the Japanese company gets its green energy plant built.
That's the logic, yes. We're seeing it everywhere. SMBC recently increased its stake in the U.S. firm Jefferies to combine their lending and deal-making. We're seeing SBI, a huge domestic Japanese player, teaming up with Carlyle to build a whole platform.
The ecosystem.
Exactly. Banks handle the advice and distribution. Private capital handles the heavy lifting of the funding.
It sounds almost too perfect, like a Goldilocks scenario where everyone gets a slice of the pie. But, our job on this deep dive is to worry.
Naturally.
When we zoom out and look at the bigger picture, because this isn't just a Japan story, this corporate finance split is happening globally.
Yeah.
What could go wrong? What are the risks?
Well, there are definitely risks. This is not free money, and it is certainly not risk-free. The biggest concern highlighted in the recent analysis is liquidity.
Liquidity, meaning how fast you can get your cash back if you need it.
Right. Private credit is, by its very definition, illiquid. If you buy a share of stock on your phone today, you can sell it 5 seconds later. But if a fund lends $100 million to build a data center, that money is literally turned into concrete, steel, and servers. You cannot just ask for it back next Tuesday.
It's locked up in the ground.
Exactly. And this becomes a serious problem if these private funds start taking money from regular retail investors. There was actually an incident recently in February 2026 with a firm called Blue Owl.
Oh, what happened there?
It wasn't a total collapse or anything, but it really spooked the market. It was a warning shot about gates.
Gates, like a fence.
Yeah, imagine a crowded concert venue. If everyone tries to leave through the front door at the exact same moment, people get crushed. So the venue puts up barriers, gates to slow down the exit. Private funds have these exact same mechanisms built into their contracts.
Oh, I see.
If too many retail investors get scared by a headline and try to pull their money out of the fund at the exact same time, the fund just drops the gate. They say, stop, you can't leave yet. We don't have the cash.
Wow, that sounds terrifying for a regular person who might suddenly need that cash for, say, a medical emergency or a down payment on a house.
It is, and that is a huge danger. As private credit grows and tries to tap into retail money, your 401k, my IRA, there is a real risk that everyday people won't fully understand that their money is effectively stuck in a 10-year Japanese infrastructure project.
That's a massive consumer protection issue waiting to happen.
Definitely.
Now, what about the other risk? You mentioned earlier that the Japanese government is happy about getting the money to build, but are they at all worried about who exactly is lending it?
Yes, that brings us to the regulation risk. National security is a huge theme right now in 2026. Japan is aggressively tightening its security clearance laws for foreign investments.
Because if you have foreign entities, even friendly ones, essentially owning the debt on your national power grid or your critical AI infrastructure, that's a major leverage point.
Exactly. It adds a whole new layer of complexity to these deals. We are seeing significantly higher compliance costs. Deals are taking way longer to close because the Japanese regulators want to trace exactly where every dollar is coming from.
They don't want a hostile actor sneaking into their critical infrastructure through a backdoor private loan.
Exactly. They are being extremely cautious.
So bringing it all back to you, the listener, we have covered a lot of ground today. We went from the BOJ raising rates to bespoke suits to Sony music royalties and concert gates. Why should a regular investor here in the U.S. really care about the plumbing of Japanese corporate finance?
You should care, because this is a massive global signal. Japan is very often ahead of the curve when it comes to structural economic shifts. What we are seeing there right now, this massive migration from public markets and banks over to private markets, is happening everywhere.
It's a new normal for corporate finance.
It really is. If you are looking at your own portfolio, you have to realize that the safest, most high-quality companies aren't just relying on banks anymore. They're using complex private debt.
Right.
And that means you have to look closely at the quality of the borrower. In Japan, the opportunity is amazing because these are ultra-safe, high-quality companies using private credit for aggressive growth. They're using it to swim faster.
But in other parts of the world,
In other parts of the world, private credit might just be an expensive lifeline for desperate companies that are drowning. As an investor, you really have to know the difference.
that is such a key distinction,
Yeah.
using it for offense versus using it for defense.
Exactly.
Okay, let's wrap this up with a quick recap. Japan is going through a massive industrial renaissance, rebuilding manufacturing, going green, building out AI.
Right, massive CAPEX demands.
But the old piggy banks, the traditional Japanese banks in the stock market, they're either too worried about 20-year maturity mismatches or too worried about angering shareholders with dilution to fund it all.
Perfectly stated.
So private credit steps in as the master tailor, crafting these bespoke, custom loans like the $700 million Sony deal. And instead of fighting over the scraps, the local banks and the U.S. private firms are just partnering up to make it all happen.
That is the whole story in a nutshell.
Excellent. So before we go, leave us with a final thought. What is something provocative we should be mulling over as this trend continues?
I would leave you with this question. As private credit continues to grow and truly becomes the third pillar of global finance alongside regular banks and the stock market, will it eventually face the exact same regulations as banks?
Oh, that's interesting.
Right. I mean, if firms like Apollo and Carlyle are effectively keeping the Japanese economy running, does the Bank of Japan eventually lose control of its own economy? If the central bank raises rates to slow things down, but private capital just keeps lending billions on their own terms, who is actually steering the ship? The line between public and private markets is blurring so fast, and I think that is going to fundamentally change the rules of the game for every investor out there.
That is a deeply provocative thought. If you walk and talk like a bank, eventually the government is going to treat you like a bank.
Precisely. It's only a matter of time.
Well, we will definitely be watching that closely. Thank you so much for breaking down this incredibly complex topic for us today.
Oh, it was my pleasure. Thanks for having me.
And to you, the listener, thanks for joining us on this deep dive. Don't forget to subscribe and hit that like button. We'll see you next time.